everybody. We are back. Last class. We're here, finally. So we have the last one for this evening in regards to real estate finance. We're going to be covering tonight defaults and foreclosures. And the good thing is this is a relatively quick chapter. So we have some good information. The reason we're not going to spend a lot of time on this is because in law of contracts, if you were with me from day one, we actually talked about defaults and foreclosures, okay? And when we get to principles, we'll spend more time about it. So you probably already had a little info. We're going to kind of hammer it in a little more, and then principles will finally put the final nails in the coffin, as they say, okay? So tonight we're going to talk about defaults and foreclosures. Our first thing that we want to look at is basically the government programs for at-risk homeowners, okay? One of the key things about this when dealing with defaults and foreclosures is that a lot of times what happens is an individual will get approved for a loan. Once they get approved for a loan, what ends up happening in the situation is that they go over and they pay for the bills. They're approved. They met all of the requirements. If you remember from what we talked about in the previous classes, there are certain debt to income ratios. Remember, you have to meet certain debt to income ratio. So in the situation here is in that debt to income ratio, we have to meet the certain incomes. Now, if Stephen is giving away half of his money in order to purchase a house, if he loses his job, he's more at risk to lose his house, okay? So what happens is in the governmental programs, there can be sometimes at-risk home buyers, okay? And so the government knows, and that's why they insure. So like we talked about last night, Mr. Travis, if you're the banker, okay, Mr. Travis, you're going to go over there, sir, and you're going to end up, if you are the banker, you're going to be the one, sir, that's going to go over here, and you're going to end up, you're going to want some type of insurance before you lend that money out, okay? So if Miss Davenport's the government, and she tells you, I guarantee you, I'm giving you a guarantee that if you lend money to Mr. Eugene, if he don't pay, I will pay you. You're more likely to give him that money, okay? But in the situation is that, let me ask y'all this question. I'm going to ask you, Ms. Davenport, I'm going to ask you this question. What happens if, say, you do this, and 70% of the loans that you insure, they all default? Who has to pay those debts? Does the government just magically appear money, or does it come out of somebody's pocket? Who do you think? It comes out of whose pockets? It's the taxpayers. All the taxpayers.
So we got foreclosures all the time.
Oh yeah. Oh yeah. They're coming through. Them foreclosures are occurring. A lot. And so in this situation, what happens is the taxpayers end up in this situation. Well, if Mr. Eugene fails to pay, yeah, Mr. Travis still gets his money. But guess what, Mr. Eugene? You not only affected yourself, but truthfully, you did affect Travis and myself and Aiden and Miss Davenport and Miss Leela and everybody else that's listening tonight. You affected them because that tax, that money, had to go pay off your note. Now, does that mean you get to keep the house? Of course not. No, not at all. What happens is if you default, Mr. Travis has to sell the property, recoup the money, and any monies that are not paid, he gets the money from Ms. Davenport. So he doesn't get the full value, he gets the monies that are going to be leftovers, if that makes sense. Okay? So in these situations governments understand that most homeowners, if they're an FHA, VA, USDA, they know that there's a higher chance that there's a possibility that there could be foreclosures. They understand that. And like Ms. Davenport said, there are always foreclosures going on at the courthouse. Okay, always. And so if it's not foreclosures, it's tax sales. So in those situations, it basically in this situation, you're going to have the governmental programs and they help people that are at risk. Now the government also does give out loans to certain people where they give you a grant. Not for the whole purchase of the house, but they give you a portion of it, you got to pay the rest. Now you have to meet certain income requirements for that. But again, we're not going to go into that tonight. That's for a later discussion. But again, what you need to know is under these defaults and foreclosures, the government does have programs for people that are at risk. Okay. There also, loan failures do lead to accelerated foreclosure rates. If you remember back in 2008, 2009, even some into 2010, foreclosures were going through the roof. The market went crashing down, foreclosures went up to the point that at that time, Obama had to actually try to put a halt to it. He had to put a halt because here was the problem. What happened is some people would end up, they would not be able to pay. So they would do what's called a deed in lieu of foreclosure. I'll just turn over my house in lieu of you not forcing the whole foreclosure process. I just sign away my house, okay? Well, in that situation is, you technically, so if Aiden, you wrote a deed in lieu to Travis, okay, and Travis, you just get the property back, well, Travis still technically, if he sells the property and all, and he makes his money off of it, Travis still basically ended up granted you some leniency, because if he gets the property back and he sells it for $250 and you're supposed to pay $450 over the 30-year period, you got some basically benefit out of it, okay? So Travis would hit your credit report, and then Travis would go over there and send you at the end of the year a 1099 for a bad debt. So he would write a bad debt to you. So say the house was $250, he sold it for, say, $240. There's $10,000 loss Travis took. He would issue you a bad debt for $10,000, and you had to end up paying taxes on it, okay? And what happened is, and in some situations, thankfully Obama helped the economy in this situation was, there was so many people that couldn't afford their properties, that guess what happened, guys and gals? They couldn't afford them. Their banks were taking them back, and people were not paying. So back in that time, if Travis sold your house, Aiden, guess what happened? He was only probably getting maybe $200,000 on the $250,000 loan. He's losing money. Now, unfortunately for you, the government's paying him that additional $50,000. Okay, but guess what? What Travis was doing? He's saying, "I'm losing $50,000." So at the end of the year, he would kick you a $50,000 bad debt. So you ended up, say, you made $40,000 in 2010. Well, with that $50,000, you technically made $90,000. So you had to pay taxes based on $90,000, not your $40,000. Do you see how this works? So in that situation it's imperative that you understand how these work. A lot of times think that if I go over here and I just I turn over my property, then I'm good. I can walk away scotch-free. Okay? That's not how it works. Okay? You still are going to get hit with a bad debt. You're still going to get hit with things. You're still going to have a bad credit report. So again, when you talk to a client, you want to explain to them the importance of going through this process. It's not something that's easy, okay? Also, when we're talking about defaults, what happens in this particular situation with defaults is that there is what's called an acceleration clause. So say, for example, that Mr. Grossman here, he has his property, he's paying for it, and he pays and he pays and he pays. And halfway through his note, guess what happens? Mr. Grossman goes over here and he loses his job. So Mr. Grossman loses his job in this situation, and Mr. Grossman says, "Oh crap, I can't pay for my mortgage anymore." So the first month comes around, Mr. Eugene, and he doesn't pay you. He doesn't give you a payment for the month. So you send him a collection notice. Where's my money? Mr. Grossman goes over, and Mr. Grossman ends up saying to you, he says, "Mr. Eugene, I don't have the money. Okay, I don't have the cash." All right. So Mr. Eugene ends up in this situation. He says, "Well, you need to get me paid up by next month." Next month rolls around, still no payment. By the third month, guess what? He has basically he has breached his note, his promissory note to you. And so you enforce the acceleration clause. You tell Mr. Grossman that because you have made 3 months of non-payment, Mr. Grossman, you must pay that full amount of money to me for the entirety of the loan. Did you hear me there? The entirety, not just the 3 months, but the whole loan is due and payable immediately. Okay? That's an acceleration clause. Why do we do this? Well, think about it. Imagine this situation, how busy poor Miss Davenport would have been if it wasn't like this. She's at her job, her old job, she's there, and every single month, Mr. Eugene, that he missed a payment, you had to go down to Miss Davenport to file a lawsuit against him for every single payment. And imagine if every landlord had to, for 30 years, for every month, had to come down there to Miss Davenport to file a lawsuit. Okay? And you can only sue him for just that month's rent. You would be there, Miss Davenport would never, she'd be set for life. She'd be set for life there. So in that situation is the court system said, no, we need a clause that basically enforces where after 3 consecutive non-payments, I can, as the borrower or the lender, go and file 1 lawsuit for the entirety of the loan. So that Stephen can't sit in the house while he's over here defaulting month after month after month. Okay? Because that would have just been a court's nightmare. They're already backlogged already. They can't handle anymore. Now, there are, however, they use the word workouts. Okay, that's not going to a gym. Okay, that is actually, if you want to put next to it, it's called a loan modification. Okay, you can end up in this situation if there is a default. Say, Mr. Nobles, that Mr. Grossman, he did not pay you for 2 months. Okay, and he calls you going into the 3rd month and says, Mr. Nobles, I ended up, sir, I cannot pay you for this month. However, I have a job that's lined up and I start the 1st week of the 4th month. Would you please not invoke the acceleration clause, and can we restructure my loan to put the missed payments at the end of my loan? Now, Mr. Nobles can end up, what can you do, Mr. Eugene? Can you agree to those terms? Yeah. He can agree to those terms. He's the lender. It's just like if you go if I walk over to Travis and I say, hey man, here's your $20, pay me back on next Friday. And then Travis calls me and says, bro, I'm actually out of town next Friday. Can I pay you the following Monday? Okay, pay me that following Monday. In that situation, me and Travis can work that out. Huh?
I'm also out of town that Monday.
Oh, you're out of town that Monday too?
Yeah, I'll be out of town then.
For eternity?
Yeah, and the next time I'll probably be out of town. Yeah. I'm really busy.
You're really busy? Well, one of these days, right? What, like my dad,
I'll let you know.
like my dad, he's already thinking the same thing.
But if you do have extra money to give him, you said he'll be in town.
Oh, he could be in town to get the more money?
Yeah. He's not anything else all the year.
But then
I don't got much going on.
But see, it comes back to that situation is, yes, I mean, you can work out your plans. You can modify. Now, do you think every bank's going to work with you? No. During the Obama administration, he actually mandated that banks must work out to the best of their abilities a loan modification. Okay? Because the fact of the matter is, if banks didn't, what was going to happen? You're going to have banks taking all of the houses back, and what we're going to happen to the people? They have no places to go. And once you file foreclosure, what do you think your chances, Mr. Grossman, you're currently dealing with this? If you got a foreclosure on your credit report, what's the chance of you renting a place?
Pretty much zero.
Zero. Zippo. So where are you going to stay at? On the streets, right?
Yeah.
On the street. In your car. Exactly.
Until they repo it.
Until they repo it. Yeah. So in that situation is, guys and gals, yes, Obama had to make a decision, and a lot of people were furious. Banks were like, well, I shouldn't have to be forced to modify my loan when Mr. Stephen didn't pay his payments. Well, think about it this way, Mr. Eugene, if you're the one that said that. Well, if Mr. Grossman's out of a house and everybody else is out of a house, how are they going to pay any of your debts?
That'll make money somehow.
Yeah. So in this situation, would you rather end up letting Mr. Grossman take 12 months and put to the end of his loan and let him stay there and try to find a job in 12 months and you just get no money, but you're still getting interest? Or would you like to end up, you kick him out and good luck, you're just destroying your own business?
I think I'll let him stay there.
Yeah, you think he's
I'll come
going to?
ask him after that.
Yeah, So in that situation it goes into these, like I tell people all the time, it's imperative, okay, that you end up, as you're going through, that you're going to be watching these different strategies, okay? Now, what exactly are delinquencies? Okay, what exactly are these different delinquencies? Well, the very first one and the most normal one that we all know is principal and interest. If I don't pay my principal and interest, or let's turn it around this way. Mr. Eugene, if you don't pay your principal and interest on your house, what does the bank do? Do they just say, oh, that's fine, Mr. Eugene? Is that what they do?
I think so, don't they?
Yeah.
That's how it works.
You're good.
Yeah.
We got you this time.
Is that what you do, Mr. Baker Ayton? And you just, oh, it's okay, Mr. Eugene, you just pay whatever you want. Is that how it works?
For Mr. Eugene, yeah.
Everybody
Everybody else now.
That's $50 on the table.
Unfortunately, Mr. Eugene,
They don't
Miss
want
Davenport, she's your banker. She ain't that nice, so I'm
Oh,
sorry.
thank
So she's worked in the county long enough. She knows all the excuses you could ever think of.
Oh,
So
man.
I guarantee you, she's got them all down. So, but if you need Miss Leela, she has got plenty of clients open. She can talk to you about your sob story.
There we
So
go. Thank you. Thank you, sir. Thank you.
at $250 an hour, by the way.
Oh, whoa. Bank, you know this money.
Might as well pay the.
So,
Yeah, just make an appointment.
make a point.
Right?
So, but yeah, when you're dealing with your principal and interest, your bank, they're not there to be your friends. It's business. You don't pay, they're going to say, out, okay? And that's going to be, if you want to put next to it, principal and interest deals with the mortgage. So the mortgage company is going to be the one that brings that action against you, okay? Now, can you, Mr. Travis, can you be delinquent on your taxes? Is that such a thing?
Yeah.
Yeah? Man, you're telling me that the tax man can come take your stuff?
Yeah. A
Man,
lot more than you think.
yeah, a lot more than you think, right?
Your wages, everything.
They gonna come get everything they want from you.
Right, you don't get it, so.
You don't mess with the tax man or woman, not at all, okay? So in that situation is, yeah, Mr. Eugene may be current on his mortgage. He may be paying Miss Davenport every month. He's paying her every single month. But Mr. Travis, Mr. Taxman back there, he ain't paying you for 2 years. Yeah.
I'll take you sometime.
Yeah, he'll tell you sometime, Mr. Travis. He's like that Miss Linda.
Yeah.
You seeing a problem here, man?
Oh, yeah.
So in this situation is, you got this taxes, you don't pay. Now here's what's most interesting, okay? And this actually is true. Mr. Eugene, you can live in a town where your taxes at your county may only be $1,000 a year, maybe $2,000 a year.
Where's that?
Okay? And just it's more of your rural areas, not your big cities, but your rural areas. Your taxes may only be $1,000 or $2,000 a year. Okay, you're not going to be in a big city, but you're going to be in a small rural area. Now, that property you're in, you may end up be paying Miss Davenport, say $4,000 a month for your big mansion and all this land, but you owe Mr. Travis $2,000 a year for taxes. Okay, well, you're spending all your money to Miss Davenport for your mortgage, and you can't pay Mr. Travis. So, Mr. Ayton, I got a question for you. Do you think that if he's current paying Miss Davenport, but he does not pay Mr. Travis in the back for $1,000 a year, he fails to pay his taxes, are they really going to actually take Mr. Eugene's $400,000 house from him over $1,000 for not paying taxes?
Without a doubt.
Really? You mean Travis would be that mean?
Oh, yeah.
Man. So Miss Travis, you're going to come in and force Mr. Eugene out and sell his house over $1,000.
For him, I'll do it.
You'll do it. So
His
in
wife
that,
tells him 100,000.
there's your reason.
That will be a lot of money.
So in this situation is yes, the property taxes in this particular situation is yes. Mr. Travis is a tax man or a tax lady, whoever it is, can come in and actually force the sale of your house for any amount that they deem necessary.
Yeah, I don't like you giving y'all money. Y'all owe me so much money.
Yeah.
All the different jobs I've been doing. Yeah, I don't like you giving y'all money.
But in this situation, you got that property taxes. Mr. Stock can go in there and yes, he can take it. There have been, and I've seen them on the tax roll, the tax history, and Miss Davenport, you might have seen it too. There are some that are $300. They have a $300,000 house, and the tax person's taking their house to a tax sale for $300. Yeah, they will force the sale. Now, in that situation, Mr. Eugene, what happens now is let's ask this. Let's change the subject here. Okay, you paid Miss Davenport. You had a 30-year loan with her, and you paid her 29 years and 6 months. Okay, so you only have 6 more months to go. And now you owe Mr. Travis only $1,000. Can he force the sale of your house?
Sure, he can.
Yes, he can.
Sure, I thought.
Even if you were at the month before your last payment, and you have paid Miss Davenport 29 years and 11 months, and you only just have one deal left, and you owe Mr. Travis $1,000,
You don't take my house.
he can force the sale of the house. Now, do you get any of that money back?
No.
Yes, you do.
Oh, I do.
Yes, you do. But here's the best part. You ready? So they go over, and because you didn't pay Mr. Travis $1,000, Mr. Travis, number one, he's got $1,000, but now they have to file court papers and all of this stuff and all these things. So that $1,000, by they do all the court fees and all of that stuff, now it's probably $5,000 or $6,000 that you now owe. So Mr. Travis sells your house over $1,000. He sells your house, and he sells it for $300,000. Okay. They're going to pay Miss Davenport her last payment. They're going to take their $6,000, and then whatever's left over, they'll give it to you. So they're going to kick you out of your own house over $1,000. Okay? They can do that. That's why I always tell people, whenever I advise people or I'm having consultations with them, I always tell them, you never, 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 never mess with the tax man or woman, period. You do not mess with the IRS. You don't mess with the county tax, state tax, local tax. You don't mess with those people with taxes. You want to lose everything? Screw around with them. Okay? Just gonna tell you, screw around with them. Don't do it. Okay? Pay your taxes. Because yes, there was actually a person, an individual had owned their property, a home in Houston. Now this was back in 2008, so don't think you're gonna find it now. Back in 2008, there was a house in Houston. An individual did not pay their taxes of $350. Went to tax sale. The guy was like, yeah, you ain't selling my house for $350. There's no way you would do that. They did a tax sale, $350. Guy ended up, got his house, the entire house, for $500. Bought the entire house for $500. They can do that in some situations. Okay? You do not, guys and gals, mess with the property taxes. You do not mess with the property taxes. Okay? There can also be other liens. There can be other liens on the house. Say, for example, I keep picking on you, Mr. Eugene, just because it makes it consistent. You go over and you now have hired Aiden to come out to your house. So you're current with your mortgage, you're current with your taxes, but you've hired Mr. Aiden to come out to your house. And Mr. Aiden, guess what he needed? He needs you to do some landscape work and put a pool in his backyard for him. Okay? You go over there, you take care of it for Mr. Eugene, okay?
Yes, sir.
So you go over there, Mr. Eugene, you put all that in, you bring all these people in, pay all your laborers and all that stuff, and you finish it up, and you go and say, okay, Mr. Eugene, here is $50,000 for the bill. I need you to go ahead and pay me. I'm finished, sir. Mr. Eugene looks, man, looks wonderful. I'll get you a check in the mail, Mr. Aiden. You've done such a great job. I'll get you a check in the mail. So Mr. Aiden said, sounds good, Mr. Eugene, and he leaves. Okay?
That was his first mistake. He owes me a lot of money. Maybe.
So you left. You wait for 10 days. You still ain't got that check for Mr. Eugene. What you do, Mr. Aiden?
Go down to the courthouse.
Well, are you gonna do that? Or are you gonna call it?
Oh yeah, I'll give a call first.
You gonna call it?
Yeah, yeah,
Okay. Mr. Eugene doesn't answer your phone call.
yeah. Oh,
I'm busy.
he's done.
And so you wait another 15 days. You're thinking, oh, he's waiting 30 days. Normal 30 days. That's normal. 30 days lapses. You still ain't got nothing. Call Mr. Eugene again. His phone happened to just get somehow disconnected.
Sorry.
I don't know how that number got disconnected. So by now, what are you going to do, Aiden?
Oh, he's done. I'm going to the courthouse.
You go into the courthouse. So you come down over here to Miss Davenport and you file your paperwork and you filed suit against him. And they serve it. So Mr. Grossman comes out and serves Mr. Eugene and he's like, that's sorry, you know what? I was going to pay him and that's sorry. I was going to pay him. I don't know what his problem is.
Yeah, what is this problem?
Okay? Because he was going to pay you, man, just next month.
Yeah.
Okay?
On the next one.
Yeah.
Yeah.
So he goes over here and Mr. Aiden, you go ahead and you say, you know what, I'm not going to do it this no more. I want my money. So Mr. Eugene no shows. So Mr. Grossman here, the judge, grants you a judgment. You go and you attach that judgment to Mr. Eugene's house. You can force the sale of Mr. Eugene's house to get your payment. He can be kicked out of his house because he cannot be undue advantage. He cannot unfairly make money off of something that he should not have made. Does that make sense? Okay. So there are other types of liens. Now, one lien, I will tell you, be careful here. It's very interesting here. Is do you think, I'm going to kind of poll everybody real quick. I'm going to poll the people here in the class, and Stephen, I'm going to let you poll the people online. Do you think that you can lose your house because of unpaid credit card debt? How many of you, raise your hand, how many of you say that you could lose your house for unpaid credit card debt? If you say yes, you can, raise your hand. One. How many say no? Two. Okay. Mr. Grossman, can you poll the people online for me? Call their name and ask them.
Okay. What do you think, Colton?
Yes, you can.
Okay, got a yes.
All right, Darren.
Not if you have like the homestead.
Okay, we got one. All right.
Enrique.
Can you hear me?
Yeah, we can hear you.
I don't think you can lose your house for credit card debt. That ain't got nothing to do with mortgage.
Okay.
I still
All right, who's next?
Enrique.
Enrique, are you there?
Okay, Keith.
Yes, sir.
Do you think you can lose it?
Hold on. No.
No? Okay. All right, Keith?
I would say yes. I agree with Garrett with the homestead. If you don't have the homestead,
Okay. All right. Who's next?
Leela.
Miss Leela, what do you think?
I don't think so.
Okay.
Marcus.
Marcus? Wait for it.
Lastly, Mr. Jacob.
Mr. Jacob, do you think you can lose your home for credit card debt?
I would say yes.
Yes. Okay.
Okay.
So you can see here, everybody's what? Pretty much what? Split.
Half and half.
About half and half. Okay. So in that particular situation is Mr. Garrett, Mr. Keith brought up a very good point. If a house is homesteaded, they cannot force the sale of your house for credit card debt. They cannot force the sale. Do you know the only people that can force the sale? the tax man or woman, or your mortgage. Pretty much the only ones. And at some points, maybe a mechanic lien.
Not the government?
Huh?
Not the government.
That's going to be your IRS.
Oh, it's okay.
That's the tax man or woman. Okay, those are your three. If you do not have credit card or homestead protection, yes, you could lose your house. If you do not have homestead protection, they can give you the boot. Okay, they can end up forcing the sale. That's why I always tell people, if you have two houses, I'm going to test Mr. Aiden here for a minute. If you have two houses, how many, Mr. Aiden, in this situation can you homestead? Can you homestead both houses, sir?
No,
How many can you homestead?
just one.
Just one. So you can only homestead one property. Okay? So if we're homesteading one property, Mr. Aiden, in this particular situation, we are homesteading your main house. What if you do not, again, Mr. Travis gets screwed here again. You owe Mr. Travis $100,000 in credit card debt. You have two houses. What happens?
My bank goes out of business.
Your bank goes up.
That's what happens.
Travis, you really need to get another
I'm
career.
really
Man.
gonna find my clients.
This banking business, man,
It's
is
really
ain't
hard out
working.
for me. That's how I got into real estate.
But in that situation, Mr. Travis could force the sale of your second house, but not your first house. That's why a lot of doctors and lawyers do what? What do they end up doing? They get a huge house, and every time they make more money, what do? Bigger house. They keep building up more and more, but they only have one house. Okay? And they'll drive a very fancy car. Okay? But that's one exception. See, under the rules, you can have, basically in the situation, you can end up having a huge house, because in Texas, there's not a limit on your property. So you can have a $10 million house, your homestead. You have a car, very fancy car, it's exempt. Okay? So in those things, there are certain exemptions. Now, if you have multitudes of houses and cars, you only get to keep one of each. If you're married, you would get two. So that's why the government does not want, what is it, polygamy? Yes. Because the fact is here's the problem. If you have multiple wives and multiple spouses, what ends up happening? You can have multiple exemptions. You see what I'm saying? And so government does not want that. They want to limit it. There's a reason they do what they do. They want to limit it. But there are other liens in this situation where that you can possibly lose your house. Okay? Homeowners insurance. If Mr. Eugene, you fail to maintain homeowners insurance on your house, they can take back your property because you promised to pay your insurance. Now, there's one other thing I wanted to show, talking kind of about other liens, but if you want to add it to the bottom, you can lose your house because of your homeowners association. People are like, what? My HOA can force the sale of my house? Yeah, they can. They can force the sale of your house. If you do not take care of your property or do not fulfill, for example, let's put it this way. Mr. Eugene, you end up, Mr. Travis and Mr. Aiden and Ms. Davenport, Mr. Stephan, and myself, we all move into your house, okay? But your homeowners association, bylaws state that you can have no more than 2 unrelated individuals in your area.
Oh, you're all family then.
Huh?
You're all family.
No, not that. You'd have to go through the adoption process.
Oh, I already got it.
Oh, you already did that?
Yeah.
But in the situation is that, yes, you could, if you violate the homeowner, your HOA rules, they can kick you out. Okay? So in these situations, they can't force the sale because you're not abiding by the rules. Or if you owe HOA dues, they can kick you out. Okay? Well, a lot of people kind of have a little hesitant because they don't like that extra layer of basically possible losing their property. Okay? That's why a lot of people don't like HOAs. if you're not managing your property, Mr. Eugene, you got that money you owe Mr. Travis and you're living there. And Mr. Travis, when you sign your note, he's sitting back there. He's not supposed to know about this. Oh, Mr. Travis, you're not supposed to hear about this, or just FYI. So, so in the situation, Mr. Travis, guess what? Mr. Eugene's not been maintaining his property. He's not been mowing the yard. He actually went in and did some homemade renovations himself, because he watched Tim the Tool Man, you know, that whole show.
Oh, yeah.
He watched that and did some improvements himself.
Home improvements.
Yeah, and yeah, you know how it was supposed to be a 2,800 square foot place? About 1,300 right now, sir, with all the walls he's knocked down. So your value of your house has dwindled significantly.
It'll be bigger.
So when he's done, he'll have it. You know, he's still trying to put the mobile home in a catch it. So yeah, poor management here, poor property management can end up in that situation. It can actually cause for the lender to come in and take it. I had a client ask me today. Actually asked me first thing today. He said, "Well, the house currently they put in the attic. They kind of filled it in, and they put AC in there, but it's not finished out. But it is cooled. So when you get into the attic, you open a door. You could finish it out, but it has heating and cooling in there if you want to turn it on. And so in the square footage, they counted that as square footage. So he says, to drop my value, I'm just going to take that out, and then end up, my taxes will go down." And like I told him, I said, you do that, your lender is giving it based on the property being what? How many square feet? 2,800 square feet. Mm-hmm. If you go take out 300 square feet, what happens to the value of that house? Dwindles. And that lender is not going to be happy. Okay? They're going to mandate you put it back. Okay? So in that situation is that if your clients are going to do any type of improvements, they need to be improvements that are not, you know, Tim the Toolman Taylor type of improvements. Okay? Mr. Aiden's sitting back there going, "What the heck are you talking about?" So go home and Google Tim the Toolman Taylor. Okay? Just FYI, go home and Google that. All right?
Is it similar to Bob the Builder?
No, sir.
Oh,
No,
okay.
sir. But you'll get a good laugh. You'll understand what I'm talking about there.
All right.
So
Show's coming back.
Tim Allen. Mr. Aiden, I'm just curious, about how old are you? About 5, 6 these days? 7?
No, 22. 22. Bank.
Little young kid.
I have to give you a hard time.
You just better whip behind you.
Yeah. But in that situation is, yes, I mean, you do have these, like I said, property, you've got to make certain that your property meets certain standards, okay? Now, there are adjustments, okay? There can, in this situation, there can be what's called the final foreclosure action. Now, once a property in Texas basically goes through foreclosure, do you think that person is able to get their property back? Once they say sold,
That's it.
can you get it back? No, it's done. It's finished. Okay? So once a final foreclosure action is done, in some states, it's done. In other states, and I got to add this in here because this is part of the national exam, in other states, they do have moratoriums where they allow you a redemption period. So we have sold the property to Mr. Grossman up here, but Mr. Grossman, you have to give Mr. Eugene up to maybe 6 months for him to redeem the property. But during the 6 months that you have it, the government allows you to charge him 18% per month for his amount that you put out there. So if you ended up, you gave him $100,000, guess what, Mr. Eugene, you get to pay $118,000 back to him for 1 month. And it does compound. Okay? So in that situation it basically what they're trying to do is stop you, Mr. Eugene, from coming back and purchasing the house. Okay? But there is a right for them to end up basically allowing a redemption period. Not all states allow that, and you have to look at your individual state that you're in, okay? There also is in some, you can do what's called a recasting. And a recasting is where basically they're re-looking at the loan and trying to redo the terms. We're trying to basically work things out, okay? We've talked about the deed in lieu. Deed in lieu is basically where I say, you know what, screw it, I can't pay it. Here, Travis, here's the deed, I'm out of here. I don't want to go deal with all this, I don't want to go to court, I just want to walk out and say adios, okay? I've had one client years ago, client went in, we talked, we did all the stuff. My client said, you know what, Justin, I'm just sick of it. Just get me out of this. I'm tired of it. I'm tired of the phone calls. I'm tired of the hassling. The lender even hired a private investigator to go to her house and knock on her door and not really harass her, but say, hey, where's my money? You didn't give me money. If you don't give it, we're going to take your house. Well, basically kind of harassed her to a point. She said, I'm done. I'm finished. Leave me alone. Okay. What I ended up doing was I said, well, what's stopping you from moving? She said, I don't have the money to move my stuff. I have too much stuff. Sound familiar, Mr. Travis? Mr. Aiden? So in that situation is, I talked to the lender, and the lender said, well, we hired an attorney. It's going to cost us $5,000. How much is it going to move her out of the house? I said, about $1,500. We'll give you the $1,500 if she just signs the deed in lieu. So the bank literally gave her $1,500 to get her crap out, just to get her out of there, because they knew it was cheaper than hiring an attorney. So yeah, deed in lieu is a way. Now, don't think, and a lot of clients get this assumption, well, if I sign a deed in lieu, what that basically ends up meaning is, I signed a deed in lieu, I'm out of this whole thing, and they ain't going to destroy my credit. Woohoo! I'm out. Nope, because it's still going to go to an auction, and they're still going to try to sell it. And most of the time, they're not going to get what they asked for. They're not. Okay? So in that situation is, a deed in lieu does not give you a free pass or a get out of jail card, basically. Okay? You still have to sometimes take a hit on your credit, and sometimes you get a bad debt IRS form, or sometimes they'll still sue you for that bad debt, that amount that's still there. Again, some VA and FHA provisions, if there's an issue, they will push it to auctions. They'll sell properties at auctions. Realtors through their broker can bid on these different types of ones. But I want to tell you, it's not your typical real estate transaction. It's not Mr. Travis where you fill out a 1 to 4 family and you go through this and it's all perfectly like you've been taught, okay? It's nothing like that. Sometimes it is being behind your computer, typing in some of the terms and sending it in and hoping for the best. Good luck talking to anybody. You're not even going to get your client into the house to look at it. It's basically sight unseen. Okay? You just happen to see it. And this is where that comes back to that abstracting part that I was telling you about. The key point about abstracting is this, is that with the abstracting portions, your client may not even know if they're actually getting a clean title. They may be purchasing this and not actually get a clean title. Again, we talked about equitable and statutory redemption periods. Again, you have to look at your own individual state. Each individual state completely different, but you want to check it. Now, again, we do have these different types of or foreclosures. There are different types of ways of we doing things. So in this situation, is like we talked about, is that there are going to end up being, in some situations, a judicial and a non-judicial foreclosure. Okay? A judicial foreclosure is often used for conventional FHA and VA guaranteed mortgages. Okay? And what this is that, Mr. Eugene, if you fail to make your payment, you actually have to have a judge involved in it. Okay? And you have to go up there and you actually got to get representation, you got to hire an attorney, and it's just big old mess. Okay? But also you got to get on the docket. Now, judicial foreclosures, who do you think they sometimes benefit, Mr. Stephan? Who do those normally benefit? Does it benefit Mr. Eugene for non-payment, or does it benefit Mr. Travis as the lender?
Travis.
No, Mr. Eugene. Yeah, you know why? Because Miss Davenport, how quick does the court system work? Are they extremely speedy people? No? You're telling me they're slow? Man. So, Mr. Travis, when you go file your stuff, guess what happens? You may have to wait probably a year or more before you can get to court for the judge to hear your case. And by the way, while you're there, Mr. Eugene's furious at you. So what do you think he's doing to your house that you're about to get back?
They're destroying that thing.
Oh, he's going in there and he's doing some more handyman specials for that house for you. You know, just like the new one where you take some concrete, pour down the toilet and flush it. That's a new one. It increases your value. So yeah, it really helps you out. And throwing, nails throughout the driveway, putting some hose in your wall, probably use the restroom all over the house, spray painting it. He's helping you out. He's trying to increase your value during those 12 months.
Might increase the value of that house and stuff we're trying to sell.
Yeah, exactly. So in that situation, like we tell people is that it can, and people always ask me, they always say, you're telling me that tenants or people actually pour concrete down toilets? Yes. I had long time ago, when I first was a real estate agent, I managed a house where the tenants got mad because we were about to evict them and they poured concrete down the toilet. Mr. Eugene, how
And the tub.
and the tub.
Was that expensive to replace, I'm guessing?
Was it expensive? Miss Leela, what do you think how cheap that is to replace some stuff like that?
15, $20.
It's simply not cheap.
Yeah.
Yeah, 'cause you gotta get under the.
Oh, you gotta bust walls out, you gotta get in there, it's not easy.
Depending on how far the concrete went, yeah.
That's like putting sugar in a gas tank or something.
Yeah. Pretty much, that's about what it is. So in that particular situation, like I tell people all the time is that yes, you don't want to be able to wait. Mr. Stahl, if you are going to force Mr. Eugene out, you want to do it fast and quick. You want to get in, have him have a deed of trust, get all that stuff taken care of, and get that deed back and get him out of that house as quick as you can. Okay? So in that situation if you want quick, fast and quick, you're non-judicial foreclosure. Okay? It's fast, quick, and we're out. Okay? Not slow. Because I can tell you guys and gals, tenants, I've had some of the best people in the world, and I've heard this from other agents and other brokers. There are some extremely qualified, and I'm talking qualified people that will go in and they will destroy a house if they're about to be evicted. They will destroy a house if they're about to be evicted. Because they do not want the lender to get a house back in good condition. Because of the fact is, what do they know? If Travis gets the house back in good condition, then Travis is going to resell it quickly. They don't want that. But here's what they don't understand. And this is what I try to tell them. Is Mr. Eugene, if you go pour concrete down it and you destroy the house, who do you think is ultimately going to pay for those repairs, sir? Do you think Mr. Travis?
No.
Who is?
Probably the buyer.
Yeah, you are. You're going to, in that situation, for all that damage, Mr. Travis has to pay to get it fixed. That goes in the amount of debt you owe him. So he's going to add that on top of your already debt that you owe him. And so he's going to end up doing what? He's going to sell the house. He's going to get, maybe if you owe $250, well, you did $50,000 in damage. So now you owe $300. He sells the house for $200. Guess what? There's $100,000 still left, and he's coming after you. And not only is he going to get a judgment against you, but he's going to let the IRS know that you didn't, or that you gained, basically off of a bad debt, $100,000. So now you got to pay income tax on that $100,000, and you're going to have a judgment against you for most likely the rest of your life to have to pay back that $100,000, and interest as well to it. Okay.
Just take it that long.
Yeah.
Apparently, yeah. That's how I run things. You can do whatever you want.
Yeah, Travis, if anybody needs loans, Travis is your guy.
Oh, man.
Y'all just go back there, he'll get you hooked up. So He just goes in and just lends to anybody. No requirements, no application process. It's just, you just come in, he'll give you some money. So, but, but in the situation is, yes, there are going to be those types. Now, there also is strict foreclosure. And strict foreclosure deals with that contract for deed. So in this situation, Mr. Travis, you might want to use this now one for next time. You don't give Mr. Eugene the deed or anything until he's paid you your whole term of your loan. So you hold the deed, and Mr. Eugene is basically just renting the property. And if he doesn't pay you, guess what? Get out. Okay? There is no trying to get the deed back because you still have the deed in your name. Okay? Now, if a client wants to do this method, should you as a real estate agent deal with it? No. You do not deal with the contract for deed. Now, it doesn't mean that you can't represent the client. It just means that you're going to be going to the attorney with them a ton because the attorney needs to draft the paperwork. Okay? Do you think that, say, Mr. Aiden, you go out and you went to attorney Leela and for with one of your clients, so you and Miss Davenport, your client's Miss Davenport, you go to Miss Leela. Miss Leela drafts up a contract for deed for Miss Davenport. She gives it to you. Can you just go copy that and use that again next time?
No.
Why not?
Because I'm not a law professional.
You're not a lawyer. So in that situation is Miss Davenport's situation may be completely different than, say, Mr. Colton. Mr. Colton may end up, his situation may be completely different, and if you take that form and just make a copy, you may have cost Mr. Colton thousands and thousands of dollars. Okay? So can you represent a client in a contract for deed? Yes. But a lawyer needs to be involved. Now, a lot of people will say, but wait a minute, Mr. Nobles, you told me in a contract forms class that there's a form about this, so seller financing. Yeah, if you recall in seller's financing, yes, there's a form, but what did I emphasize? It must be reviewed by an attorney. You do not, in any shape or form, use that form until an attorney has given you clearance. If you go out and you do that without your broker's knowledge, you put yourself and your broker at huge risk. Okay? Not only your broker and you, but even your client. Okay? And sometimes your client, once they sign it, they ain't getting out. It's not easy. Guys and gals, it's not easy to just get out of it. Okay? Now, they do have foreclosure by advertisement. A lot of times what they'll do is they'll put it in the newspaper and they will say, we have a foreclosure occurring. Anybody that wants to come bid on it, meet us at the courthouse steps on a Tuesday, probably the first Tuesday. Okay? Depends on your county. Of course, everybody's different, but it's normally on a Tuesday. Okay? There also is restrictions on entry and possession. If a house is normally in foreclosure, it depends on the bank and it depends on a lot of different things, but some will not let you even enter the house. Mr. Eugene, if Travis is foreclosing on your house and Miss Davenport wants to go look at it, she can go walk around the exterior, but she can't get inside. She can't go in. Because the fact is that there are restrictions on entry and possession. Okay? And a writ of entry is basically a right in order you're requesting a judge so you can enter. Okay? Whenever you see writ, you normally have to have a judge approval. Okay? And that's for the lender, not for you as a person wanting to purchase it. Okay? There are a lot of rules that goes into this. If Mr. Travis was like, you know what, screw all the rules, I'm going in there, I'm going to grab Mr. Eugene by the collar of his neck, and I'm just going to throw him out of the house. Okay? Well, Mr. Travis, you'd be trespassing and some other criminal charges against you, even though Mr. Eugene's the one at fault. Okay? Landlords, a lot of times, they get so frustrated, they're like, this sucker won't move out of my house. He won't pay. He's damaging it. Do something. There's not much you can do. Okay? Except let them damage it and end up in that situation. Once they damage it, there's not much you can do. You just have to ask after the fact. Okay? Now, what about foreclosure miscellaneous? Like I said, this is after the fact. After Mr. Eugene has been kicked out and his house is sold, of course, like I said, they are not a bank is not going to always get what they actually owe. What Mr. Eugene, you owe him. You owe him, say, $200,000 or $250,000. You did $50,000 in damage. So when he tries to sell it for $300,000, his top offer he gets is from Mr. Aiden, and Mr. Aiden gets $200,000. It's sold for $200,000. This does not mean, Mr. Eugene, that you get to go, ha, yeah, I got him. I got Travis. He owes $100,000. I'm smart. No, it doesn't do that. Okay? He's going to sue you, Mr. Eugene, for a deficiency judgment. He's going to come in and he's going to sue for the additional amount. And Miss Judge Davenport here is going to grant him a deficiency judgment against you for $100,000. Okay? However, if you had an FHA or VA loan, Mr. Travis can't do it. Because why? What do we talk about? Anything that is deficient, who pays for it? The government. So Mr. Travis under a VA or a FHA you cannot double dip, okay, in that situation. You cannot end up double dipping, okay? So Mr. Travis cannot go through that particular situation and end up double dipping and making a lot of cash. You see what I'm saying? He has to end up in this particular situation. He can only sue if it's conventional loan, okay? There is tax impacts as well, Mr. Eugene. Now here's the thing, Mr. Travis cannot double dip under an FHA or VA. But guess what Mr. Travis can do? He can report to the IRS that you got a gain of $100,000. And because you did, guess what? You now have to include that in your yearly income. So while you may think, ha ha ha, I'm smarter than Travis, I outsmarted him. He thought he knew what he was doing. Nope. He's going to, at the end of the year, you may not hear from Travis for 12 months, but sure enough, Travis is going to wait until the end of January of the following year, and he's going to issue you a bad debt 1099. And guess what, Mr. Eugene? You're going to have $100,000 that's going to be added into your amount. So if you made $100,000, guess what you made for last year? $200,000. Okay? It's funny because a lot of people come to me when I sometimes do taxes, and they'll come to me and they'll be like, whoa, Mr. Nose, I got a question. I'm like, what's going on? Mr. A, what's the problem? Well, I only made $40,000, but this thing came in the mail from my old mortgage company. It's $100,000. Well, Mr. Aiden, did you happen to get your house foreclosed on? Well, yeah. Well, Mr. Aiden, did they sell it for full amount? I don't know. I just left. Well, you didn't follow up with them? No. Well, Mr. Aiden, you got to include that, because if you don't, tax man or woman's coming down for you. Okay? So in that situation is you don't want that. Like I said, you don't want to be messing around with tax woman or tax man. Not at all. Okay? So in this situation is you got to be very careful because some of them can. Now in 2007, the Mortgage Forgiveness Debt Relief Act was what Obama passed. And it basically said that during this certain period, the IRS could not come after a person that would put them in the home. They were already damaged. If you lost your house, you pretty much don't have any more money. Like my mother always said, try to get the blood out of a turnip. Okay, good luck. It's not going to happen. Okay, so in that situation it's very key that you understand these differences because each and every one of these differences play a huge impact. Your clients may come to you, and I'll tell you guys and gals, it is going to happen. People don't believe me, but it is going to happen. What happened last year in 2020 is going to create a huge mess in 2021 and 2022. And you're going to see a lot of people, sellers, that had bought a lot of houses now start having the squeeze of the financial economic pressure that we've had. And you're going to see foreclosures and all go up. I see this in many different elements. Every time in 2008 when this all started, I saw when I used to teach at the college, I still teach at the college, when I taught there, we saw a huge influx of students in real estate. And for about 7 years, there's a ton of business for everybody because everybody's hurting financially. But after 7 years, the market has rebounded, came back to normal, and guess what happens? There's too many real estate agents because the fact is everybody's now got everything settled back down. Okay? So you see real estate agents kind of do this, just like the market. Okay? So what ends up happening is you do have these different situations here, but you need to be advised that your clients, that just because they do a deed in lieu, does not give them a free out. It's not a free out. There are certain requirements that you need to be aware of. They're not just something that I can just freely get out of this. Okay? All right. So with that being said, we're going to go ahead and stop lecture. There's no more slides for this. So Mr. Grossman, can you go ahead and please stop lecture there for me? Stop the recording.